There you go. Good morning, everyone, and welcome to our fourth Tuesday of June. It's June 25 to our tax savings Tuesday. Today, we're going to discuss different ways on how you can manage your business income while taking care of your personal finances. I'm Chris, business developer of Wycoco Tax. We provide virtual accountants and tax planners in able to increase your cash flow but not your taxes. We're going to discuss the different topics today on from your credit score. But before that, let me share my screen, and I hope this my desktop will coordinate. I don't know. There's so many technical issues that we're experiencing right now. Okay, it's loading. We're trying to share my screen. But when you share your screen, it's not. Should I refresh it? Okay, there you go. So I'm sharing my screen right here. And we're back. Present. Okay. All right. So we're going to discuss about on unlocking your personal finances for professional gains. We're going to go over with the three topics: how your personal credit score can affect your ability to secure business loans. Also, utilize how your personal savings to fund your business startups and expansions, and then the effective income management to ensure personal financial stability while running a business. If you want to have a copy of this presentation, all you have to do is text your full name and email to get free copy of this presentation. Send it to 515-992-6829. Again, to get the free copy of this presentation, send it to 515-992-6829. And this webinar will only be less than 30 minutes. The participant, you can type your questions here on the chat. There's a private chat section, and we will answer it later. And then if you want to access the 10-step business improvement checklist, go to our website, www.wycotax.com. And you can also watch some of our past videos on our YouTube channel, then subscribe and able to enter to our gift raffle. Disclaimer that this material has been prepared for informational purposes only. It is not intended to provide and should not be relied for any tax, investment, legal, or accounting advice. Examples and other materials in this webinar are only for illustrative purpose and should not be relied upon for technical answers. Wyco Tax is a virtual outsourced accounting and wealth planning company, and we are not associated with any institution on this presentation and is a business providing resources for small businesses. So we're going to jump into the topic. This presentation are meant for small business owners, self-employed, and work from home, people that are receiving 1099s with S Corporation, LLCs, or partnerships with or without employees, e-commerce, non-accountants, and if you're making more than 90,000, you are our target listeners. Because in 2022, the tsunami of IRS audits, they're hiring 87,000 new agents to audit small business errors or small business owners. So avoid the trial and error approach that will cause the IRS red flags that paralyzes your business. So the very first thing that you need to understand if you want to secure the loan is understanding your credit score. Because when you have a small business, the IRS has a 3-year look back to check on the expenses on your balance sheet. And then as a startup business or you're expanding your business, the categorization of your income and expenses are very important. Now, in able to expand and able to start, the credit score is one of the main foundation that have you the capacity whether you can get the money or not. So, but what is a credit score? A credit score is a numerical representation of an individual's or business credit worthiness based on their credit history. This score is used by lenders to evaluate the risk of lending money or extending the credit. Here are the key points about the credit score. So there are the range. The credit scores typically range from 300 to 850, with higher scores indicating better credit worthiness. Then the three main credit bureaus in the U.S. are Equifax, Experian, and TransUnion. So basically, there are different banks. They would like to look before you even apply for the working capital. Might be at 600 range or up. Some of them, depending, especially business loan, I saw a lot of six range in 600. It's better for you to have a free consultation with your lender first before you even apply for the loan. Also, it's important to know that you need to let them or tell them that you don't want any hard pull on your credit score. It needs to be just a soft pull before doing anything else. Okay, that's one reminder that I've always talking to our client. All right. Now the question, how to increase your credit score? You can use the following. These are the different percentage criteria. They have payment history, 35%, amounts owed 30%, length of credit history 15%, new credit 10%, and then credit mix, it's another 10%. So when you say payment history, it's this are consistency in paying the bills on time. So typically, always have my payment auto pay, and then how much you owe, the total amount of debt, and the ratio of credit used to available credit. I think more or less you should have settled at least 75% of your total credit card balance in a month-to-month basis. Length of credit history, how long the credit accounts have been active. So the longer that your credit cards or you've been using it for more than 10 years or so, the better you will be at position because they give 15% on that bearing. New credit, the number of recently opened accounts and recent credit inquiries. Some of them, there's a revolving credit. Let's say, for example, on our case, uh, when I blew up my tire, two of my tires need to be replaced. Instead of me paying it on my own credit card, I got this offer for replacing the tires, and then I use this car tire credits. They allow me to pay it in 3 months with 0% interest. So that is a new credit that I added on top of my Capital One credit card. And then the credit mix, 10%, the variety of credit types such as credit cards, mortgage, and installment loans. So that's why you have a mortgage payment, you have a credit card payment, and then you have installment loans. You can combine any of the two or three together. Now, from the credit score, for example, you don't really need credit score to finance your business. There are different options. So the first one, this one, you don't need the credit score. This is what you call bootstrapping. So when you say bootstrapping, it involves using your personal savings or investing the profits from the business to fund the operations and growth. The advantages, of course, you don't rely on your credit score. You have full control, retain complete ownership and decision-making power. You don't have debt to the bank or any private investors. Then motivational, encourages frugality and efficient use of resources. But you also have to consider the drawback. There might be limited capital. Growth may be slower due to limited initial funding and then personal risk. Financial risks is solely on the entrepreneur because I mean when you're starting your business, you still have personal bills to pay. So you kind of pooling your resources on your month-to-month personal family bills just to fund your business. So you kind of weigh your options, which direction you want to go. Do you want to put more budget on your business, but you live in frugal? Maybe you cannot buy a new house, or maybe you cannot uh, buy a new car, or even education plan for your kids because you're starting the business, and then maybe you want to study for MBA. So those are things that are can wait and something that you have to push back if you really want to start your business or expand your business out of your own funds or savings. The other option you want to consider, if ever that you want to grow your business, is the business loan. Again, we talk about the credit score because this is where the credit score will kick in. The business loans are borrowed funds from banks, credit unions, or online lenders that must be repaid. I forgot to mention that the SBA can also give you the money. Small Business Administration, it's a branch of the government for funding resources for small businesses. So this, but it requires a repaid interest over a period, specified period. There are different advantages. you can have larger capital, access to significant funds for expansion, equipment, or operations. For example, in the 12 months, you need 10,000 per month. So that's 120,000 of money that you need to ask for to the bank. Then you can also maintain the ownership. Unlike equity financing, loans do not require giving up share of the business, especially if you want all the 100% control. Maybe you and your wife, you just keep it in the business. Then the bill credit, timely repayments can improve business credit scores. Considerations, the qualification requires a good credit score and sometimes collateral. We go back again that the credit score plays a big role when you are loaning money. And then the debt burden, it's another. Regular repayments and interest can strain cash flow, then risk potential for financial trouble if revenue falls short. So the rule of thumb, check how much would be the interest that you're paying over time versus how much is the potential in net profit of your business. For example, you're only paying 6% on the loan that you borrowed to the bank, like 120,000 in per 6% 15-year payment plan, but your business is making a 30% net profit every year or every month, making that net profit, then you can consider that your business is it's a good debt. However, if it's a bad debt, it's like you're paying 30% interest on that 100,000 loan, pero you're only making 3% every on your sales. So that is a bad debt. So that's why you have to go back to your drawing board and consider your other funding options. That lead us to option number 3 on how to fund your business is equity financing. So the equity financing involves selling a portion of your business to investors in exchange for capital, and this can include the venture capitalists, angel investors, or crowdfunding. Larger, the advantage can provide substantial funds, especially from venture capitalists or angel investors. Repayments, there's no obligation because no repayments, no obligation to repay the funds as with loans because your investors are taking equity of your company, so therefore you're sharing the risk. The question is how many percentage of the risk are you both sharing? Is it 50-50? Is it 70%, 30% them? And expertise investors often bring valuable experience, connections, and advice. So for me, I think if you want to have to still that control that ownership, but having more money, to consider silent investors. Okay, but it's something that you have to negotiate and talk. Why you like a silent investor? Because you want to make a lot of decision making on your business. They just want you really want them for money. And also another consideration why I'm bringing investor are the networks and how they're gonna elevate your business to the next level. And the following to consider: owner's delusion requires giving up share of ownership and profits. Shared control, investor may want to say business decisions and high expectations. Investor typically seek a significant return on their investment. So that's why this takes time. You getting to know the investor from their value, their culture, the industry, the expertise. Okay, so there you go. And then how to fund your business. Each funding method has its unique benefits and drawbacks, and the best choice depends on your business specific needs, growth potential, and your willingness to share ownership or incur debt. And then number 3, how to manage your business income. Try to separate your business and personal finances while keeping business and personal finances separate helps you to maintain clear records, simplify tax filings, and protects personal assets, and set up separate accounts, pay yourself a salary, and even use an accounting software. Then create a stick to a budget. You need to do forecasting, set aside emergency funds, and plan for personal needs. Then diversify through different tax sheltered investment vehicles. So aside from making your money from your company, you need to consider different investment strategy aimed at reducing risk. Either you just diversify, opening a 401k, IUL, annuities, IRA, or even maybe purchasing your own, if you have a coffee shop, purchasing your own real estate. Each of these tax sheltered funds offers unique benefits and can apply a significant role in comprehensive financial plan. The best choice depends on individual financial goals, risk tolerance, and investment horizon. So that's why consulting a financial advisor can determine the most appropriate options for your specific situation. That's why the benefits of outsourcing, it gives you peace of mind, save headaches, save time, and then save money, and then faster access to grants and loans and this kind of expertise. You don't get it by doing it yourself. Everything. So the business and Wyco tax, we provide worry-free year-round competitive and on-time accounting and tax planning service solution. If you have further questions on how you can minimize your taxes while increasing your cash flow, feel free to contact us today, and we will give you a free report from your entity record keeping, like this pie chart from the expenses to your in tax credits available, different shelter plans you can use, and then filing your return. So we're offering a one-time bundle. Once you do your accounting and tax filing with us, we're offering you a $500 discount. And announcement, there's a business economic injury disaster loan, which in Dallas area, where it gives you a 2 million access on $2 million working capital at 4% interest for 30 years, and you don't have to pay after 12 months when you get it. So all you have to do is connect with us again. Thank you for listening on our Tax Savings Tuesday. Watch this replay on our YouTube channel. And if you have further questions, feel free to book your consultation with us. Again, I'm Chris, business developer here in Wyco Tax. We increase your cash flow, but not your taxes, because we break your taxes that each one of you can take a break. Stay safe.